But primarily when you look at just public debt and current deficits and current account deficits out of DC and the CBO, the world knows, and they've known for a long time, really since 2008, and then since 2014 when they started net dumping U.S. Treasuries and net stacking gold. The world doesn't trust U.S. Treasuries as a safe haven because the country is in so much debt. You don't usually lend to a friend or a borrower or even a meth addict who's constantly not paying you back the amount you expect or with a valuation that's safe, because the currency itself and the yields themselves don't beat actual honest inflation. So because there's so much debt, that's one reason we want less and less to do with the U.S. Treasury. When I say we, I'm talking the global markets.
Welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're diving deep into the dynamic world of gold, global markets, and the shifting tides of the monetary system. I'm thrilled to welcome Matthew Piepenburg, partner at von Greyerz Gold in Switzerland, to the show. Matthew is a renowned expert in precious metals and wealth preservation, offering sharp insights into the global financial landscape. Matthew, it's an honor to have you back on to Metals and Miners.
Oh, it's good to be back, Gary. Thanks for having me.
So, Matthew, in 2011, the S&P downgrade of U.S. credit triggered a sharp and rapid decline in the 30-year Treasury yields, indicative of a flight to safety. However, following Moody's recent downgrade of U.S. credit, the 30-year Treasury yield has instead increased. Why the divergence in market response to similar credit rating downgrades, and what specific risks does this upward movement in long-term yields following the credit downgrade pose?
Yeah, look, I mean, I'm not a fan of long-duration U.S. debt, long-duration sovereign bonds, 10, 20, 30-year bonds. They have what's called a term premium. And basically that's the quote-unquote juice you get for holding long-term U.S. IOUs, 20, 30-year bonds. The 50-year average is about 1.5% for that. Now, as of today, it's zero. So you're getting no real juice for the long-term hold. And what does that mean? It means if you wanted to get back to the 50-year average, we'd have to get yields up to 6%. In other words, bond prices have to come down even more to get yields up to 6%. That creates a massive paradox, though, because if yields go to 6%, just so your viewers understand, the yield on a 10-year or a 20 or 30-year, the yield on the U.S. Treasury is really the real interest rate, the cost of debt. And as you go on the longer end of the longer duration on the yield curve, if you're getting to 6%, as we saw under Powell's higher for longer policies, when you push yields up by pushing bond prices down or raising interest rates, whatever the forces are that pushes yields up, the markets cannot handle higher for longer. They cannot handle higher yields. So Powell's inflation policy failed because the rising yields and the rising rates caused the stock markets to have their worst nominal return since 1871, stocks and bonds. That was in 2022. What we just saw in the Great Liberation Day on April 2nd, when Trump, whatever you think of Trump, when he tried to impose these tariffs at a very high level, especially against China and the EU, his first salvo, we lost 10 trillion in market cap in a few days, and bond yields spiked to 4.5%. In other words, there was no safe haven U.S. Treasury. And that meant that not only could Powell not fight inflation because the bond market wouldn't let him, I would argue that the bond market wouldn't let Trump go into a full-born chest-puffing tariff attack on Europe, Canada, and of course China. The bond market didn't let him. And why? Because the bond market in the last 5 years, the U.S. Treasury is the worst performing asset. It's down 50% the 10-year. So again, I'm not making these things up. The bond market is less loved, less trusted, less of a safe haven than it was in my dad's era, my grandfather's era, and frankly, when it was 10 years ago. To get back to your point about the ratings, whether it's a Moody's or whether it's the global financial markets, and I don't have a lot of faith in the rate agencies post-2008, that's a whole other rabbit hole. But regardless of the official rating, the world's already telling us what they think of the U.S. 10-year, 20-year, 30-year, long-duration IOUs from Uncle Sam. Because Uncle Sam is at 37 trillion in public debt with another 100 trillion plus in unfunded liabilities, and then you add corporate debt and household debt. But primarily when you look at just public debt and current deficits and current account deficits out of DC and the CBO, the world knows, and they've known for a long time, really since 2008, and then since 2014 when they started net dumping U.S. Treasuries and net stacking gold. The world doesn't trust U.S. Treasuries as a safe haven because the country is in so much debt. You don't usually lend to a friend or a borrower or even a meth addict who's constantly not paying you back the amount you expect or with a valuation that's safe, because the currency itself and the yields themselves don't beat actual honest inflation. So because there's so much debt, that's one reason we want less and less to do with the U.S. Treasury. When I say we, I'm talking the global markets. After the Liberation Day on April 2nd, the next day there was a Treasury auction. Nobody showed up. It was crickets. Typically, it's the central banks and the primary dealers. In the first auction, they're about 18, 19% of the buying. The day after the tariff announcement, we had 1.5% central bank and primary dealer interest in Uncle Sam's IOUs. Again, because Uncle Sam is no longer as credible as he was 10 years ago, 20 years ago, certainly 60 or 40 years ago. So in addition to being over our skis in debt as a country, Uncle Sam being over his skis in debt, in addition to that, when we weaponized the U.S. dollar in 2022, whatever, again, you think of the geopolitics of the Ukraine war, which I'd love to discuss because it has a lot to do with Europe, but whatever you think of that war, the policy of freezing the FX reserves of the R in the BRICS, which is making trade arrangements with the C in the BRICS, had massive ramifications because it ignited this whole BRICS discussion, the de-dollarization discussion we've been talking about for years. So a weaponized dollar and an over-indebted dollar means the U.S. Treasury, which is also a weaponized over-indebted IOU, is empirically less loved than it was in the past, hence the ratings downgrades. Again, it's just a question of debt and weaponization. And the solution to every problem really, certainly since the great financial crisis in 2008, you could go back to when Greenspan, who I call the patient zero of a totally destroyed monetary system, you go all the way back to 1998 during the dot-com bubble or the real estate bubble, the idea of manipulating rates or printing money and then printing money at mass when Ben Bernanke came in and got a Nobel Prize for this magical idea that we can solve a debt crisis with more debt. All that did was the world isn't as stupid as we think it is. If you and I can figure out that when you print money out of thin air to monetize your debt and to pay for your debt, and you debase your currency and you issue more and more debt, your debt's going to be less trusted. If you and I and your audience can figure that out through common sense, just like we went to a bank every week for a new loan, at some point they're going to probably recredit us or revalue us differently. Well, China's known this really since 2008. They certainly saw it by 2014. The BRICS certainly understood this very clearly by 2022, and we weaponized this over-indebted thing, this IOU. So again, I'm not saying this is a gold bug to be anti-credit, anti-debt. Credit, when it's done in moderation, works. Debt in moderation works. The U.S. is way past moderation. And so it's over-indebted and it's weaponized. And the combination is meant since 2014, central banks prefer they prefer gold, physical gold over U.S. Treasuries. In 2022, when we weaponized the dollar, the average central bank annual purchase was 118 tons. Now it's 290, 300 tons. So again, you just have to follow the direction and the empirical objective evidence of what central banks are doing. And it's a long answer to a short question, but the Treasury is less trusted, less loved.
Appreciate the answer. Yeah, appreciate that answer. There's a lot in there. I want to ask you about Treasury Secretary Scott Bessent. Matthew, he has stated recently that the administration aims to stabilize the debt to GDP ratio by growing the economy faster than the current 6 to 7% deficit to GDP, which he notes is historically high outside of war or recession. I'm sure you saw him making this comment. But given the significant challenges that this presents, what specific policy measures or economic strategies are you aware of that the administration intends to implement or can implement to achieve this accelerated economic growth? And if they can't grow their way out of this, what's the alternative or most likely path?
Well, look, I'd like to be third baseman for the Yankees. I really would, but it's not going to happen. and I like to play.
Hey, they need a third baseman. I got to be honest.
And again, Scotty Bessent, I'll give him a lot of credit because unlike Janet Yellen in the last administration, this is neither red nor blue. This is just objective reality. The discussion by Bessent, is far more at least direct that we have a debt problem. He wouldn't maybe say a crisis. I think we're in a debt trap. It's objective, but at least he's being objective that we have to use words like deficit to GDP or GDP to tax receipts or GDP to debt ratios. At least he's openly talking about them and admitting we have a problem. When Janet Yellen was in front of the Senate a few years ago, I don't think she even knew the exact number of our budget deficit. She was flipping through her papers and pulling the classic Fed two-step. So in one regard, to answer your question, at least Bessent is addressing a problem. To say that he can solve a problem is a different issue. I give him credit for addressing it. He understands history and markets and financial debt levels and ratios better, I think, than many politicized financial figures in D.C. But he should also know, and I think he does, that when you get debt to GDP at a ratio of greater than 100% or 120% or 125%, as every mathematician and every business school professor will tell you, and as David Hume said in the 18th century, when debt to GDP crosses such a level, the growth is cut by a third. That's mathematical. So you can't get more growth in the backdrop of this debt. And if you want to get more growth, you have to cut the debt. The GDP cannot rise once you've crossed 120, 125, or frankly, even 100% debt to GDP. That's academic. It's also historical. So for this to succeed, the policies he would have to make, where can you actually cut the debt? Again, Doge, great. Cut $2 trillion in spending. See if that works. Do it in the next 2 years. That's optically wonderful. It's better than nothing.
It doesn't seem to be happening, though.
Again, we're not nearly at the 2 trillion rate we want to be by our birthday, at 250th birthday in a couple of years. But even if they met their $2 trillion goal, even if with U.S. aid they weeded out all the corruption, it was only good, smart spending instead of corrupt CIA spending, and God knows what else we do with that money. Even if you could do that, as I've said many times, is a Band-Aid solution to an open chest wound, a major artillery shell in the gut or chest. A Band-Aid like that is not going to get us growth. The only real line items that we can, quote unquote, mess with, I mean, we could cut entitlements, Medicare, Social Security, benefits, political.
That's not politically feasible. Yeah.
I don't think so, unless you have a war, a crisis to justify it. Or you could dramatically cut military spending. I'm talking 40, 50%, not 5 or 6%. So again,
but there's a lot of entrenched, I don't know what the right word is there, but groups that will fight that tooth and nail.
Oh, absolutely. I mean, Eisenhower wasn't kidding when he passed the torch to a new generation of JFK and warned us about the military-industrial complex, which is more than just the Pentagon. It is all the spooky things that the dark state does in the U.S. and at the BND and the DGSE and at MI6. They're the real powers. I'm sad. That's my opinion. Again, given that it's very difficult to cut the military spending and to cut the entitlements, realistically, it's going to make it very hard to get that GDP moving when you've got so much debt to bring down. And again, I've said it's like trying to swim with a major cannonball tied to each ankle. That debt just holds you back. And so since I think it's going to be very difficult to actually politically and realistically cut those type of major budget holes by 40 or 50%, then if you can't grow your way out of this debt crisis, you're going to have to inflate your way out of this debt crisis. As Paul Tudor Jones says, and I've said many times, all roads lead to inflation. History proves this. Math proves this. The bond market's telling us this, that inflation that used to be a threat to policymakers is now a policy of policymakers. It's inflate or die. They have to debase the currency. They have to expand the money supply. They have to print money to monetize their own unloved, untrusted IOUs, to keep bond yields down, to buy U.S. Treasuries, which no one else wants, to keep those yields down and affordable for Uncle Sam. And so that, to me, is what Bessent isn't going to say out loud. If he wants more growth, he has to go back to his business school books or back to history, and he'll realize that's impossible at these debt levels. So if you just look at history and math, it's easier said than done, Scott. That's all I'd say.
So, and those are all great points. So, Matthew, some are postulating, though, that the U.S. might tax capital flows to balance the trade deficit, effectively monetizing the financial markets rather than gold or other assets that they own. Do you see that as a likely potential, and what problems could arise if they did that?
Again, it's kind of like what they want and what is possible. And again, I'm not saying I know all the things that are possible. I'm going to go with what is likely. Putting cost controls or capital controls on capital flows is a wonderful concept, but will the rest of the world agree to that? Putting tariffs on creating the External Revenue Service to come up with a better solution for our labor shortages or a trade imbalance is a concept, but the world didn't allow us to do it. Fighting inflation like Volcker did in the 80s by raising rates. Powell liked to do it, but he couldn't do it. I'm saying these are all desperate ideas, like the Bitcoin Strategic Reserve. It's a desperate idea. It has optics. The Loomis bill has power. It has optics. All of these things we're seeing, including Greenland or Panama or tariffs to the moon or the Bitcoin Strategic Reserve. Again, I'm not trying to say this is the fault of this administration. No administration can fix the debt crisis that we're in now. No person, I've said cryptically, Santa Claus can't do it, but the Wizard of Oz can't do it. And so it's not about being partisan. It's about being real about debt. And again, this goes back to the 17th century. It goes to Reinhardt and Rogoff. It goes to von Mises. It goes to Ernest Hemingway. When you get debt to these levels, your options are minimal to none. And so all you have are more bad options. And to me,
so
yeah, go ahead.
I'm sorry. Yeah. So someone else has mentioned that the U.S. wields its financial markets as the ultimate bargaining chip, and that in the current trade and currency negotiations, that we might already be quietly restricting their access in order to generate a couple of points on each transaction there. What do you say about that? Is that possible, or do you think that would push rivals to build and seek alternatives faster?
Necessity is the mother of invention. When America came out of, towards the end of World War II in 1944, it wasn't over. We were clearly coming out of the end of that war. With the help of the Soviet Union, we brought down the bad guys in Europe. We were the world's greatest creditor and the greatest manufacturer. We created the world reserve currency. It was redeemable by gold. The world was not only there not to threaten us, they were there to kiss the ring because we had to. We had to rebuild Europe with the Marshall Plan. We rebuilt Japan. We had moral, heroic, and manufacturing hegemony, undoubtedly. So that was America in 1944. By 1971, of course, we welched on that. We got rid of our gold-backed chaperones so our currency could be debased and we could export our inflation to the rest of the world. For a while, we had OPEC, which made the world buy oil in U.S. dollars. That created great demand. It still does, but it's getting weaker. We had better relations with China because they were just a silly little developing economy. And then we let them in the World Trade Organization in 2001. We said, you're going to have a good advantage. Please recycle some of your trade advantages into buying U.S. Treasuries. When we were better friends with the Saudis and OPEC, we said recycle some of these oil dollars back into U.S. Treasuries. There was a time when the U.S. had the moral market and financial authority to carry a big stick, speak softly, and get the results they wanted. And you could argue we still have some of that strength in our financial markets. The S&P, the Dow, the NASDAQ is still the piggy bank for the rest of the world to go speculate, go long, and try and get a nice ROI. And so I'm not going to say Matt Piepenburg say that's a failed policy. It's not going to work. But I'm only going on what I'm seeing as the direction of the hockey puck right now. And the direction of the hockey puck is it's not the end of America. It's not the end of the dollar. It's certainly not the end of our markets, which are grotesquely overvalued and racing towards mean reversion. But to think that we've seen in everything we've tried to do, whether it was expanding NATO and getting a quick victory in the Ukraine, whether it was getting out of Afghanistan, whether it was imposing tariffs, whatever we say we want to do, the rest of the world, though, still trying to find itself is a lot of it, except for the lackeys in France, Germany, and some of the G7 countries that do whatever America says. But the BRICS and many of the BRICS coalition countries, which have many problems, I'm not saying they're going to replace the dollar or toe the line with China only, but they're getting more and more creative. We saw them get creative after we weaponized the dollar. We saw what they're trying to do with Enbridge and Kazan last year. We see what China and Russia are doing in the oil trade. We saw what happened during the tariffs when China could go to Brazil for certain things, for soybeans, it could go to Canada for oil. It could make new deals with the global south. It made a bunch of deals in Malaysia and Vietnam and Cambodia. In other words, necessity is the mother of invention for countries that don't want to toe the line. It doesn't mean it'll be easy or smooth, but the world is clearly finding ways to trade outside the dollar and make money outside of the NASDAQ and the S&P. It doesn't mean the end of America. I'm just saying it's not the same America that came out of Bretton Woods in 44 or even post-Nixon.
Much weaker position.
Much weaker position. But we are looking for measures to try and do something. But it's going to be hard.
Is it your contention that despite all of these efforts, there's really just no way to there's nothing that can be done?
I think is that, as I said in an interview a couple of years ago, there's no way out, no easy way out. To quote a movie, no way out. And as many have said, there's only bad options or the lesser of two evils. There's no easy option. Again, as Paul Tudor Jones and others have said, I think it's pretty consensus thinking that we have no choice but more bazooka money at some point to support our bond market. That's, to me, inevitable. And that also is becoming more and more anemic, more and more impotent, and more discredited as a solution. I mean, the Chinese solved.
I think one of the Fed members today came out and said that liquidity. Fed liquidity is going to be an option soon.
It is, and even Warren Buffett said recently that's not a sustainable plan for the S&P or the bond market. And he's more of a cheerleader for this market than I am, but he's also hundreds of billions in cash for a reason. And Thomas Hernig, another Fed president, said, look, we're short-sighted. This is not sustainable. Monetizing our debt with mouse click money to solve a debt crisis is an absolute fantasy. It's worked under this thesis of modern monetary theory. But again, modern monetary theory is neither modern nor monetary nor a theory. It's been tried and practiced from the Romans to Yugoslavia in the 90s, to France in the 1870s, to Germany in the 30s, et cetera, et cetera. It is ultimately, from the denarius to the dollar, a failed policy. Buffett knows it. The Fed has to know better. And the world is catching on. So once bazooka money makes the dollar even less credited, more debased, and more inflating away debt, that's where I think the other, and again, I'm not crystal balling this, but the IMF telegraphed this like a psyop in 2020 during the COVID hysteria, what I consider a man-made crisis, but that's another kind of rabbit hole and tinfoil-hatted thesis. But during the COVID hysteria, the IMF and Christina Georgieva came up with this cartoon called The New Bretton Woods. You can go to the website at the IMF. It's still there. It's called The New Bretton Woods. It's an insult to math. It's an insult to history. But basically it's saying because of COVID and not because of us central bankers, not because of our usurious loans to the third world, and not because of anything done in your country is criminally negligent financial leadership, COVID is to blame for all things. COVID is the real crisis, not us, God forbid, not us geniuses at the IMF or Basel. None of us. It's COVID. Let's blame it. Klaus Schwab chimed in to agree. There's another great credit, great credit from Klaus Schwab, always a credible witness. And what they were saying in 2020 is once that crisis becomes like World War II, again, an insult to World War II, but because it is such a modern crisis, we're going to have to, revert to some type of new Bretton Woods, which is a restructuring of debt and a new kind of global currency, central bank digital currency, which is with another hour of this discussion. But they've already telegraphed this kind of new world disorder in 2020. As every PSYOP does, you give it about 5 or 6 years lead time. You can say, we've been planning for this. There's no doubt that train's left the station. There's no changing it. But what is interesting about even the IMF, of which I'm absolutely no fan, but even as they start to roll out and PSYOP and sugarcoat this centralized control masquerading as financial freedom, when they bring us these CBDCs as bazooka money fails and as the world tries to find order in the disorder, that central bank digital currency, even in their video of 2020 and the white paper that came with it, that new currency has to be backed or correlated in some way by a physical hard asset, which is gold. And there's got to be a coverage ratio. So not only am I, as a gold bug, saying this, the IMF is saying this, the BIS made gold a tier 1 asset in 2023. So I'm not saying this as a gold bug. Even the bodies that I despise, like the IMF and the Bank of International Settlements, even they admit that for anything to have credibility in this new global disorder, it has to have a gold coverage to it. It has to have a gold component because otherwise it's just electronic fiat, which no one trusts. And so I think these are things that listeners have to keep in mind. It's not just buy your gold coins and ounces through Guy in Switzerland. No, look at history. Look what the bad guys and the good guys are both agreeing on. The gold has to come in. And so that is the answer. There is no way out. They'll bazooka money. That will fail. And then they'll go to a Bretton Woods 2.0. It's not a Plaza Accord. It's a mix of the Plaza Accords and Bretton Woods. And by the way, it's not Plaza 1980 New York City where America could force the Japanese to make the yen stronger, to make the dollar more successful in its trading, because America isn't the America of 1980, and China and the BRICS aren't going to be as accommodative as Japan was in 1980. So it's a very, very different world. Again, I'm not trying to be cynical. I'm a patriot, but we got our governments and our central bankers and our budget officers and our two stirrups of the same saddle, Republican, Democratic parties for years put us in this situation. They bought time, They bought votes, they bought prosperity on a credit card.
Yeah. All right. So very well put, all of that. I've got a few questions on gold. I know that you've called yourself, not as a gold bug, but I just want everybody to know you worked on Wall Street for several decades. I believe you were part of a hedge fund. You did not focus solely on gold. This has been a decision, a career and life changing decision that you've made, as you've read the tea leaves, as you've seen where the puck is going. So I just want folks to understand that. But getting back to some questions here, Matthew, global gold funds are on pace for a record 85 billion inflow this year, more than double the prior peaks. How might that, alter gold's market dynamics compared to past cycles?
I mean, look at already this is even for a gold advocate, even for someone who understands. And I look at gold as an investment, not as a trade. So it's a very different perspective. But look at the rise, the exponential rise in gold in just the last 24 months, the last 36 months. Just in the last 14 years, it wasn't long ago, gold was at 1,600. And I said at some point it'll double, but I couldn't predict. Even that's faster than I expected. Egon, myself, many hedge fund managers that I know who come from the bond space, who come from the banking space, we didn't go to gold because it was an easy trade. We went to gold because we saw the long-term direction of currency debasement through debt monetization, through the signals in the bond market in general and the sovereign U.S. Treasury market in particular. The writing's been on that wall for years. When gold was down at 300, it was an obvious fat pitch, not just as a value play, but is to get in early on an asset that's totally undervalued and in a macro backdrop, which totally was a tailwind for that asset. So my advice as an asset, of course I have a bias on gold. Of course I have a bias on gold because I have an absolute disdain for paper money. Historically, mathematically, and in the backdrop of debt like this, that isn't being cynical, that isn't being gold bug. That's just being historical and common sense. And that's why it's not discussed at the Goldman Sachs Private Wealth seminars. That's why it's not discussed at the RIA around the corner from you. And the consensus think of that, I want to say, sustained level of mediocrity of 60-40 portfolios, which, by the way, gold just broke away from the 60-40 portfolio after a 10-year base. It's outperformed it. But again, it's not to be smug or to make a trade. It's about tracking the history of currency debasement through over-indebted, overstretched credit markets. Any bond trader who's being honest knows that's true, especially sovereign bonds. And so since there's no way out other than to inflate our way out, to use inflation as a debtor is a great thing. The government will use inflation, debase the currency to get themselves an actual buyer of their U.S. IOUs at the expense of the man on the street and the purchasing power of their dollar. And so, of course, and since that dollar is still the world reserve currency, and since we still export our inflation, and we are still the tail for now, wagging the dog of the rest of the world's currencies on a relative basis, of course that means weaker fiat money across the board. Of course that means a secular north direction in the gold price as insurance for openly dying fiat money, not as a trade. It's not NVIDIA. It's not a SPAC. It's not Bitcoin. It's not Intel. It's not Commerce One or Lucent or Microsoft during the dot-com bubble. It is real money. It is a real store of value. And in paper money, whether it's a a Swiss franc, a euro, a peso, a yuan, a dollar, Australian, Canadian, or American, yeah, they're all relative, but they're all paper money, and they're all ice cubes that are slowly melting. And they're melting in your checking account, they're melting in your 401k, and they're melting in your portfolio. If you measure wealth in paper money, you're losing as you sit here.
Okay, so let me ask you this question, and it's kind of a valuation question on gold, but just bear with me. So since 1925, the ratio of gold's market cap to U.S. equity market cap, it swung from peaks above 160% during crises to lows near 20% in bull markets, sitting today at the median of about 37.9%.
Yeah.
That's clearly closer to a bull market for the equities, despite gold's rise. Given current economic uncertainties, the inflation, the debt, the geopolitical tensions, the need to devalue the currencies, do you believe gold is significantly undervalued relative to equities right now, despite the rise we've seen?
Absolutely. It's not only undervalued relative to equities, it's undervalued relative to the M2 money supply. Because when measured against the M2 money supply, even at these prices, gold is still almost as cheap as it was in the 70s, based on the broad money supply. So again, it depends on what angle, what perspective. And yes, and equities, by the way, I got speculation in my DNA. Again, I came up as a risk asset guy, a bond guy, and a stock guy. All the guys on Wall Street knew that the varsity players were the bond traders. Because if you know the bond market, then you know how to trade equities. Because the bond market's the leading indicator. And the bond market, when debt is cheap, stocks are going to go up. When debt is high, when yields are high, stocks are going to go down. It's that simple. But you got to look at the plays more carefully. But yes, it's still gold, despite these incredible all-time highs, is still relatively undervalued compared to equities. Now, if you're trying to fight inflation, many have argued, well, the stock market can outperform inflation. I can beat inflation with the stock market. And for many years you can. And I'm not saying you can't if you know how to play that market. But remember two things. Stock markets have a very annoying habit of mean reverting once every 10 or 15 years when things get bad. And mean reversion is a force that no one wants to talk about. And you certainly can't talk about it on Wall Street if you're running other people's money, or you're working for a bank. You just won't last. Only things that survives in Wall Street are bulls. That's it. And if you run your own fund, you can be more honest with your limited partners and your clients because you're going long and short. So you can be bullish and bearish depending on your trade. But I still think mean reversion is a force. That said, even if you just assume Jeremy Siegel's model of 8% annualized on the U.S. stock market, that may have been true in a different era, not after we entered bazooka money, not after we entered the Bernanke era and the Greenspan era, and we distorted capitalism to such a degree that it's now Wall Street socialism. What I'm saying is, again, look at the Buffett indicator, over 200%. Last time we saw that was 1929 in the U.S., wasn't such a good thing, and in 1989 in the Nikkei. Massive 80% drawdowns after that. Does history rhyme? Yes. Does it repeat itself? I don't know, but it looks extremely overvalued. Not just the percentage of the Buffett indicator on the equity markets, but the fact that Buffett himself is out of the markets. Again, not really discussed. So, even Bloomberg, these are not the bears of Wall Street. Even Bloomberg puts the S&P at a fair valuation of 4,000. So again, I'm not trying to. I understand speculation. I can go long. I went long during COVID when unlimited QE gave us a signal. It was a fat pitch. Go long. I hated the markets. I hated valuations. When there's that much liquidity, Pavlovian markets like dogs with a treat are going to go up when the Fed is giving you unlimited QE. And they're going to go down when the Fed's raising rates. You can short. It's very difficult to short correctly. I'm just saying I'm not against speculation. I'm not against other asset classes besides gold. But to your question about the ratio, gold is going to have a secular tailwind. Equities are marching towards a momentous historical headwind. So, and by the way, when you see, again, bond market jargon, bond market talk, but it's important. When you see the yield on the 2-year Treasury, the short duration Treasuries get compressed because there's a rush to the short end of the yield curve. This is another insider tale that everyone on Wall Street and the bond markets knows. That's a sign when the smart money, when the whales start to reposition out of equities because they see that rush into the short duration of 2-year Treasuries. And there's interest rate swaps going negative, all this other jargon, blah, 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 show off bond talk. But the simple fact is the yield on the 2-year and the interest rate swaps are telling us that there's a repositioning out of equities coming. And history is telling us, Warren Buffett is telling us this. Grunlack, the bond guy, is telling us. Jeremy Grantham at GMO is telling us. Ray Dalio is telling us. This is not Matt, the gold executive, trying to sell pet rocks out of Zurich. This is Matt, the guy who used to trade assets for most of his life. I don't know when and how this market has its uh-oh moment. I just know that the net income margins on a very narrow number of stocks are not sustainable. And when I see those net income margins go from flat to trending south to steeply south, that's when the big short comes in equities and the big long comes in precious metals. But I never buy precious metals as a trade. I buy it because I don't trust fiat money. I want to measure my wealth, and I'm going to save in a tier 1 asset called gold and spend in fiat. That's exactly what the BIS is telling central banks to do. And I don't like the BS. And that's exactly what central banks are doing. So it's not just me and my clients in Switzerland. It's the central banks themselves.
The message that you're sharing, at least to me, is coming through loud and clear. I think everybody else is hearing it as well. I don't believe that they're just hearing somebody, as you put, spew their book. I don't think so. I know you're disclaiming because of that, and maybe you've gotten some kickback, through the years, but to me, your points are coming through loud and clear.
I was allocating to hedge funds. When I was investing in hedge funds, I didn't like being sold all the time, only the upside. I never trusted that.
Yeah.
Portfolio managers said, this is my plan, this is my strategy, this is what I think, but here's where I could be wrong. I tended to lean into those portfolio managers more. I tended to, and you have to have a BS detector. You have to be someone who's got a bias. Is it a bias or is it a conviction? And there's a difference.
Yeah.
Von Greyerz, we have conviction, but of course we have a bias, and your listeners should know that. But again,
and transparency is also important, and I feel like you're being transparent, and so I appreciate that. And I don't take what you're saying as somebody who's selling their book, just so you know. All right, so I just want to welcome everyone who's tuning into this fantastic interview with Matthew Piepenburg, partner at Von Greyerz Gold in Switzerland. It's been an awesome discussion so far. Before we wrap up here with our final set of questions for Matthew, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community. Receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the title of this report. Consider upgrading for access to premium content, but even without that, there's plenty of free content daily. So visit metalsandminers.substack.com to join us and explore. And thank you for watching this interview. Now, I'm positive that you've been enjoying this conversation that Matthew and I have been having as much as I've been enjoying it. Please let him know, hit the like and subscribe button, and leave a comment below the video. All right, Matthew, let's finish off our discussion with what I call a lightning round. You and I talked about this off camera a moment ago. I'm just going to ask you to rank a few assets as a buy or a sell. Give it a score of 1 to 100, 100 extreme buy, 1 extreme sell. But let's keep the reasoning down to 1 to 2 sentences since it is a lightning round. Let's see if we can get through this pretty quickly. All right, so on a scale of 1 to 100, right now, gold, buy or a sell, and why?
Oh, it's clearly in the 90s. It's a buy, but again, caveat, this is not a trade. This is a long-term investment. You've got to have the patience to hold this for years, not 1 quarter or 1 fiscal year. Absolute 90, 95.
Okay. 1 to 100 gold miners.
Probably in the 70s. The only reason is gold miners as a class have a long history of misusing their management and their operations and their cash. They have the highest free cash flow but the worst stock price because of bad management. I'm all about gold miners if you pick the right ones.
Okay. Physical silver.
Gold-silver ratio is inevitably going to compress. Silver, I'd probably give a 70 as well. The reason it's not in the 90s is because central banks aren't buying silver yet like they are gold.
Okay, silver miners.
Same thing about gold miners, although I think pure silver plays the few rare ones. There's one in Argentina. If you can find a pure silver play, Mexico's outlawed them. I think that's a 70 play, 70%, yep. Okay.
Copper, 1 to 100, and why?
Copper probably in the 50s only because copper, unlike copper, is an indicator for economic growth, whereas gold is an indicator for currency destruction. Because I see currency destruction as a high probability, that's why I'm higher for gold. Because I see economic growth as a lower probability, I'm going to be lower on copper, probably in the 50s or 40s.
Okay. Uranium, the physical metal.
Again, higher. I'm not much of a commodity trader outside of precious metals, but I think the world's going to have to find alternative energies, and I think uranium still is a long-term buy in the 70s or 80s.
Okay. Oil.
My friend, the market sniper, when I was in Cape Town, said he'd give oil about a 20, only because the world's going into a recession. Oil demand will fall. There's too many supply. There might be supply shocks, but demand will fall in recession. So I'd give oil probably a 40, 50.
Okay. The NASDAQ.
I'm looking for mean reversion of the NASDAQ. I would get out at these tops. I don't think we've hit a top yet, but I'd give it about a 10.
some are saying that that's where the liquidity is going to come for gold and silver and the miners and some commodities. I don't know if you feel the same.
I feel the NASDAQ is grotesquely overvalued. I'm not alone in that at all. There are plenty of
you're not.
Guys who know that. And again, that has nothing to do with my being a gold bias. It's the old hat I used to wear looking at valuations and even the technicals. And then in the fact that it's so narrow, I think the NASDAQ is just a bug looking for a windshield.
Okay. S&P 500.
Same thing.
Okay.
Less
short term.
Less volatile than the NASDAQ, but heading secularly south in a big way at some point, probably this year.
So do you put the same number on it, a 10, or is it a little higher?
Maybe a 12.
Okay. All right.
Yeah, two ugly twins.
Okay. So on a scale of 1 to 10, with each representing a percentage, 1, 2, 3, or you can go quarters or halves, where do you see inflation ending the year using the government's inflation numbers?
Well, I have absolutely zero, and I mean zero respect for the CPI scale produced by the Bureau of Statistics. I think they'll probably keep it around 3.7, 3.5. What do you mind? I think that's
okay. So you think it'll tick up a little bit from here? But they'll figure out a way to massage it down so that it's not a problem for folks, and to keep cost of living adjustment for Social Security in check so that the deficit doesn't grow wider.
Exactly, and please understand that the real inflation rate is probably 13% using the scale we did in the 80s, and we want negative rates. We just don't want to admit it, so we want inflation to be higher than the yield in the 10 years so we can inflate our way out of debt. So we're just lying about inflation. Everybody on Wall Street knows that.
Yeah, and I actually just interviewed John Williams from Shadow Stats, and we were talking about this, and it was a very interesting discussion, very similar number he put out. Okay, so 1 to 10 probability, are we headed into a recession before the end of 2025?
We're already in a recession right now. Just the MBER hasn't told us, and I've spoken about this, and I could go on, but yes. Will the MBR report it? Will the CPI be honest? I don't know. You're asking me to trust con men to give an honest report. But I will argue.
So we're a 10. We're a 10 that we're in it, or we will be. But official, by their standards,
probably
maybe a 5.
I think even the officials, I give them a 6 out of 10. But in my opinion, I'm 100 out of 10 that we're in a recession, and I've written about why.
Okay. And finally, you talked about the portfolio allocation, 60-40. That's been the standard for decades. This is radically changing. It hasn't caught, up into mainstream yet, but it is changing. And there are people who are moving away from the 60-40. If you were to include all the various asset classes, what would be your approximate recommended portfolio allocation? What would that look like?
I'd probably have 20% in equities. I'd probably have less than 20% in equities. I'd probably have 40 to 50% in cash. I'd have, again, at least 30% in physical gold for the long term. I'd be mostly in cash, but whatever I had in the markets, wouldn't even have that much in equities. I'd have very little in credits because I'd want to be in cash because I would wait for a mean reversion. I'd probably have 20 to 30% in gold for the 10, 20-year term. I'd have more in other hard assets, probably a commodity pooled asset for the long term. I just wouldn't be in equities, and I wouldn't be in a diversified or diversified credit portfolio because they're so overvalued right now and because credit and equities are so correlated. So my portfolio would be mostly cash, some serious precious metal allocation for the long term, some hard assets because we're heading into the chart of the decade, which is a commodity super cycle that will happen slowly and then all at once. But if you're looking to annualize returns or quarterly returns, there's no safe place to hide right now. I'd be more in cash despite the inflation, despite the risks. And the only way I would go long in this market is if we had unlimited QE. I'd get back on that for a few quarters until that didn't work. I mean, I'm not answering your question in a pie chart way. I'd be at least 30% in gold, probably another, gold and silver. I'd do 80% of my allocation in gold, 20% in silver. So 30% precious metals at least, 80% of that gold, 20% silver, another 10% to 15% in hard assets for the long term. And then I'd be in cash and I'd wait for mean reversion. You'll never pick the bottom, but you'll know it when you see it.
Yeah, that's great. All right. Would you share a key takeaway that you'd like viewers to keep in mind about today's economic market monetary situation? And then let everybody know where they can learn more about your work and how they can connect with you.
Yeah, the key takeaway for me, it's boring, but the bond market is everything. The bond market is a debt market. Every crisis throughout history, in every market, going back to the Persian trade huts, to the 1920s and the 1929 crash, to the Nikkei, to 1987's flash crash, to 2008's great financial crisis, picked it on the 1870s in the U.S. Every market crisis is a credit crisis, which is a liquidity crisis, which is a debt crisis. We're now in the greatest debt bubble in the history of capital markets, so of course we're going to have a market and liquidity crisis. That is not me saying that as gloom and doom. That's history. Understand the credit market risk, understand the debt risk, and the only solution to that, short of a massive implosion, is to inflate away the debt and basically purchase the stock market with debased money. That's why gold is seeing such a secular rise. Understand the bond market, understand the history of liquidity crises, which is just a fancy term for a debt crisis. We are empirically in the worst debt trap in the history of our country. And that is thanks to your politicians and central bankers and dishonest policies. You've got to do your own thinking. You don't have to agree with the thing I say. Go look at other people, whether it's me or others. We all agree we're in a credit trap. Even Scotty Bessent knows we're in a credit problem. I would call it a credit crisis. And we're trying to put lipstick on a pig politically, because that's what you do. If you're a baseball coach, you try to tell your team you're going to win every game. I've said many times, my coach said you can beat anyone. But I know my coach would have not said we can beat the Yankees when I was a senior in high school. He would never beat the New York Yankees. And there's no way to beat this credit crisis right now. That's just being wishful thinking. But Scotty Bessent is a coach. He is a politician. He has to say, go out swinging, boys. We can do this. He has to. But the truth is, we're not going to beat the Yankees. We're not going to solve this debt crisis. We're going to have austerity. We're going to have bazooka money. We're going to have some type of reset. And God forbid, I hope we don't have to have war as another distraction, because that's the other tool that these jokers use to keep them out of the blame window, because they're pathologically capable of taking responsibility for their drunk driving at the Fed and the Treasury and the White House.
Well, and where can everybody learn more about your work? How can they connect with you?
Yes, I'm at von Greyerz.gold, named after Egon von Greyerz, the founder of our company. We're also at goldswitzerland.com. Interviews, articles from Egon, myself, Ronnie Sturfula, all of that's there. We've got great advisors. We've got great legacy articles going back, so you can quality check our concerns going back. They're all kind of coming to fruition now. And it's a great free service just to get educated. Of course, yes, there is an absolute bias in favor of precious metals and an absolute cynicism about debt markets, currency markets, and geopolitical risk. But so far, we've been pretty correct on most of those risks. And but we have conviction. And guys like Egon, certainly Egon, who got into gold decades before me, he eats his own cooking. And he has done extremely well in gold investing, and he absolutely says what he does and does what he says. And he's been a great mentor to me and helped me understand no matter how much money you have, whether you measure it in dollars, thousands of dollars, hundreds of thousands of dollars, or millions of dollars, you're measuring it in an asset, in a currency that's losing value as we speak. You've got to have insurance for your fiat money. It's wealth preservation. It's not a speculation asset.
That's really well put. Matthew, thanks for coming on to Metals and Miners, for being so generous with your time, analysis, and ideas. It's always awesome to spend this time with you. I look forward to having you back on sometime soon. Everybody else, thank you for watching.
Thank you, Gary.
Welcome everyone who's tuning into this fantastic interview with Matthew Piepenburg, partner at von Greyerz Gold in Switzerland. It's been an awesome discussion so far. Before we wrap up here with our final set of questions for Matthew, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community. Receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the title of this report.